Hello and welcome back to Chapter 7 Notes. And so in this chapter I'm going to be talking about decision making and incremental analysis. So as we can see right over here, it says every decision involves choosing from two different alternatives. We need to talk about what we mean by relevant costs versus irrelevant costs. And relevant costs are those costs that differ between two alternatives. If you have a cost that does not differ between two alternatives, it is irrelevant. The only costs that would be relevant are those costs that are different. So if you have a cost that is $10 in alternative A and $10 in alternative B, it doesn't matter. So that's why when people go to the movies and 5 minutes into the movie, you know the movie's going to be bad, and I'll often ask the class, they'll say, well, how many people still stay in the movie? And a lot of people raise their hands and say, well, I will. And I'll say, well, why do you stay in the movie? And they'll say, well, because I paid for the ticket. Well, the fact is that payment for the ticket is a sunk cost. And sunk costs don't matter because they're not incremental. They're not relevant, and they're not differential costs. Because if I stay in the movie, I still paid $10 or $11 for the ticket. If I leave the movie, I still paid $10 or $11 for the ticket. Therefore, it's not a differential cost. Therefore, it's not a relevant cost. And so it just doesn't matter. So relevant costs are those costs that differ between alternatives. If it doesn't differ between the two alternatives, then it just doesn't matter. So let's go ahead and look at a couple different scenarios of decision making that some managers might face. The first one is to engage in the additional processing of a product, and then we'll talk about the decision to drop a product line, and then we'll also talk about the decision to make or buy a product. We look over here at our first decision, the additional processing decision. Sometimes the manufacturer needs to decide whether to sell a product in a partially completed stage or incur additional costs to complete the product. When we look over here, it says our Bridge computer makes personal computers. Bridge has already decided to discontinue its Model 250 computer. Currently, it has 5,000 partially completed units on hand. And to date, the company has spent $800 per unit, or $4 million, to bring these computers to their current stage of completion. The company estimates that cost of $400 per unit must be incurred to go ahead and finish making the computers. Here's our costs that are summarized. So we have the $800 to date. You can see the material, labor, and fixed and variable overhead. And here are the cost per unit to go ahead and complete them. Okay, so it's $400 right over there. And we're looking at the incremental cost. So that's why the fixed overhead is not even there. Okay, because it would be incurred regardless of whether or not we make the products. Okay, so we look over here and we continue on, and it says the price of the Model 250 has fallen to $1,000 per unit because the company has announced that they will discontinue the product. Okay, the $1,000 cost is less than the $800. It's less than the cost. Of producing the total cost of producing the computers, which is the $1,200, the $400 additional cost plus the $800 cost to date. So that's alternative one. Okay. Alternative two, so the first alternative is to sell the computers as they are. That's alternative one. Alternative two would be to go ahead and fix up the computers and sell them for a higher cost. So it says right over here, Bridge Computer chooses to sell the partially completed units as they are. They'll sell them for $500. If they fix them up and they'll sell them, they'll sell them for $1,000. So again, the alternative is to sell them as they are for $500, fix them up, and sell them for $1,000. So when you look at this, the first thing we want to think about is, are there any irrelevant costs? And yes, there is. Yes, there are. It's the prior production costs of $800. Those are sunk costs. So what I'm saying is, we look over here, if you look on that prior page, let me just get it. If you look in this prior page right over here, this $800, right? We will incur this $800 regardless of whether or not we sell the computers in the partially completed stage for $500 or we fix them up and we sell them for $1,000 for each computer. Okay? So then we go ahead and we can calculate our incremental revenue. So our incremental revenue, just make sure we understand, incremental costs are those incremental costs are those costs that differ between two alternatives. If it doesn't differ between two alternatives, it's therefore irrelevant. Incremental revenue is the difference in revenue between the two alternatives. So in this case, we have the $1,000 for fixing it up minus the $500 for selling it as is, means the incremental revenue is $500. When we look at our incremental costs, what we need to think about is the cost, the additional $400 cost to fix the computers so they can be sold for $1,000. So if we choose to sell the computers as they are, we have no incremental cost because we just sell them as they are. But if we fix them up and sell them, then we incur that additional $400 cost per computer. So now what we can do is go ahead and finish the analysis, and we can say alternative 1 is sell as is. Alternative 2 we'll call further process. Okay? And then we'll call this the variance, the difference. If we look over here, $500 to sell it as is, $1,000 to further process, the difference is $500. I'm going to go ahead and put in the prior production costs over here just to show you that it just doesn't matter. So in either situation, I incur that $800 of cost, so the difference is 0. When you look at our additional processing costs, if I sell it as is, I have no additional processing costs. If I fix it up and sell it, well then I have $400. So my incremental cost, this is my incremental revenue. My incremental cost over here is my $400, which we described up there. So now when we calculate our gain or loss per unit, we can take our revenue minus our costs. Well, we lose $300. Revenue minus our costs, we lose $200. What is the incremental profit from further processing it? Well, it's $100. That is our incremental profit. Okay? So when we think about what should we do, well, we should further process the computers. And why is that? Well, we lose less money. In either situation, we're going to lose money. $200 per computer or $300 per computer. We would rather only lose $200 per computer rather than $300. And so what we would choose to do is to go ahead and further process it. And by doing that, we earn an incremental profit of $100 for each computer. Okay? Let's go ahead and look at another example of a decision that a manager might face, which is adding or dropping a product line. Okay? So this is the next one that we'll look at. So you look over here, adding or dropping a product line is a very significant decision. In the context of a university, for example, we could say adding or dropping a product line would be something like, well, we want to drop a major. We no longer want to have the major for whatever reason, okay? This actually happened at Mary Washington a long time ago. We used to have a major in dance, and we ended up dropping the major in dance. Assuming, I was a student at the time, but I'm assuming the reason is that it just was not a profitable major and just didn't have enough people interested in it, and the costs were just too high, so they had to drop it. Okay, so that'd be the case of dropping a product line in the context of a university. So one thing we have to talk about when dropping a product line is that we have these common fixed costs. Okay, they are not incremental, and what's going to happen is that these common fixed costs will be spread to the remaining product lines. So I'm going to flip the page over here and describe this. So what we have, let's say that we have an art department, and this art department has $10. And what happens is this art department is a service department, which means it supports other departments, other production departments in this magazine. So let's say we have a magazine, okay, a magazine company, publisher, and they have magazine 1, they have magazine 2, magazine 3, and magazine 4. They have a publishing company, all right? And so what happens is they have an art department that's shared among these 4 different magazines. And this art department allocates $2.50 to each magazine because it supports each magazine in the context of developing art. Okay? So of course then they would allocate their costs out like what we talked in some prior chapters talking about service department cost allocation. So what we're saying is here, let's say we want to drop magazine 1 because it's not profitable. But what we're assuming, or what could happen, and this is what we're assuming, is that the art department costs stay constant at $10. So what happens is this $250 gets shifted to the remaining product lines. Okay? So each of these product lines now gets a larger share of the art department costs. So if you think about it, does this $2.50 cost that's pushed down to magazine 1, does this really matter if we're thinking about dropping magazine 1? And no, it doesn't, because at the organizational level, this is a fixed cost, and that fixed cost will be just spread out over these remaining magazines. And so in that reason, it just doesn't matter. Okay? So that's what we're saying over here. We say those common fixed costs will just be spread among the remaining product lines, and so therefore those costs are just not going to be relevant. So if we look at our example, it says due to the declining popularity of our watches, our company is not reported a profit for, or this watch line is not reported a profit for several years. Here's their income statement, and this is of course in the contribution margin format. We have our sales less our variable costs, less our fixed costs, and then we can see that we do have a net operating loss, okay? And we do have a few asterisks. We can see, look at this one, okay? And we can look at this one, and these are the allocated common costs that will simply be redistributed to other product lines if we go ahead and drop the digital watch line. So in that case, when we look over here on the next page, the question becomes, of course, should we retain or drop the digital watch line? First thing we need to think about, is there any irrelevant costs? And I'm going to be doing this with our shortcut way, our incremental analysis way. So let's look at cost. Let's look at costs that would be considered irrelevant if we were going to go ahead and drop this line. That means, if it's irrelevant, it means basically it's going to stay around. It's not a differential cost. So our general factory overhead, that's just going to be redistributed. So that's irrelevant. That's like the art department example I just gave you. The salary of the product line manager is going to be relevant, because if we drop a product line, we no longer need the product line manager. Depreciation of old equipment, the whole idea here is that it's sunk and we cannot get rid of it. So we're going to say that's irrelevant. Product line advertising, if we drop the line, we're no longer going to be advertising for this product line. It doesn't make sense to advertise for a product line that no longer exists. And then finally, we say over here, our rent on our factory space, if we drop the product line, we no longer have to pay rent on this factory space. And you can see it's got the 3 asterisks. And if you look on the next page, it says that means they're manufactured it in their own facility, which means, of course, that if we drop this product line, we can get rid of the rent on the factory. Then our general administrative costs, that's another allocated common cost, that is also irrelevant. It will just be shifted to the remaining product lines. Okay? So I kind of went through and I already answered this question. Are there any irrelevant costs? Okay? So with our shortcut way, our incremental analysis way, what we're going to do is look at the contribution margin if we drop the product line, and then which costs can be avoided. Okay, and then if the contribution margin that we lose is more than the fixed cost that can be avoided, we should not drop the product line. So if you look back on that prior page, you would see that we have $300,000 in contribution margin. That's the sales minus our variable costs. If we drop the product line, we will not have any sales for these digital watches. We will no longer have any shipping costs or any other variable costs because we no longer make it. So that means we're going to lose $300,000 worth in contribution margin. Now, which fixed costs can be avoided? Those are the relevant costs. And so that's the salary of the product line manager, the advertising, and of course also our rent on factory space. When we add up all these, we get $260,000. We lose $300,000 in contribution margin, but we only save $260,000 in fixed costs. So we have a net disadvantage of dropping the product line. We should not drop the product line. On the next video, I'll go through and do the long way on solving this problem. Thank you.